Hello and welcome to People and Profit, the business show that knows its bulls from its bears. Coming up, who's afraid of a little inflation? We look at why rising prices have become so important to investors. After years of steady increases in shares, is volatility now the new normal on the markets? And we turn to China to look at the cost of cutting pollution with a report from our correspondents in Beijing. First up, though, it only took a few weeks of 2018 before we hit our first stock market turbulence. Now, it's something we've heard warnings about for many months, that the equity market was due a sharp drop, given the massive gains over the past year or so. For Christine Lagarde of the International Monetary Fund, these market moves shouldn't distract us from necessary economic reforms.
The market trepidations that we have seen in the last few days are not worrying me about the imperative of fixing the roof. Those market movements were clearly, in our view, necessary market corrections. The markets have functioned well. There is plenty of financing that is still available to finance the economy. So I would not focus on what has happened in the last few days. I would focus on the imperatives of change going forward.
It was fears over inflation that caused, in part, the recent market wobbles. So what is there to be so afraid of? Kate Moody's been finding out. Kate.
Stephen, inflation is an increase in prices over time. It's broadly seen as a good thing for the economy, but only in moderation. Central banks like the US Federal Reserve and European Central Bank aim for a steady pace of around 2%. If inflation rises too rapidly, it can spook investors and prompt central banks to counter it by raising interest rates. Now, during the financial crisis, consumer prices in the US contracted below 0% in a period of deflation. They remained low for several years, but recently inflation has begun creeping towards the Fed target. It remains unpredictable and hit 2.1% in January. Some of the Trump administration's policies could play a role. Tax cuts and increased government spending may lead to a budget deficit of nearly $1 trillion next year. That could push inflation higher and trigger aggressive rate raises. As president, Trump has said he's a fan of low borrowing costs. Now, concretely, one of the reasons for the recent market sell-off was a sudden and sharp rise in wages in the U.S. in January. Higher wages tend to lead to higher prices, and that's raised concerns that the Fed would increase its pace of rate hikes. It prompted a drop in the price of government bonds and a jump in yields, making them a more attractive long-term investment for those worried about the stock market. In addition to those concerns, a rise in computer-based trading may have sparked jitters. More than a year of steady gains and record-breaking highs also meant it may have been time for a natural pullback or a bit of a breather. Stephen?
Kate, thank you very much. Well, these sort of market trends do bring back a whole range of jargon we mightn't have heard for a while. We had a stock market correction earlier this month when the Dow Jones and the S&P 500 fell by more than 10% from their recent highs. Before that, we'd been talking about a bull market, which is when shares charge ahead on an upward trend. What we haven't yet seen is a switch to a bear market. That's when the trend turns downwards, so named because of the way a bear attacks. Let's talk to a man now who knows all about bulls and bears. Jasper Lawler is the head of research at London Capital Group. Jasper, we're not quite in the bear market territory yet, but could we be heading there?
It's a distinct possibility, Stephen. I mean, markets were in such low volatile, steady trend higher for over a year that just that sort of extreme in one direction requires an extreme in the other direction once it finally begins. And my feeling is that actually the market needs a bigger reaction than we've already seen for investors to really start feeling that some confidence that they've seen the lows. And so there are different benchmarks for it. For example, a 200-day moving average is one place that the market tends to move to when it's moving to its average. And so I think we probably see a move below there in that extreme reaction. And we've seen some data over the past few days that probably supports why that can happen. It was in fears of higher inflation and the potential for higher interest rates that initially caused this crash in prices. And we've seen a bit of data from the US and the UK and other parts of the world showing higher inflation. So there is that news and fundamental backdrop to support the fears in the market at the moment.
Do you subscribe to the view that this is our healthy correction that we've been waiting for, and do you think it's going to go much lower?
Well, I'm not a big fan of this phrase, healthy correction. Markets do ebb and flow, obviously, and so what you do typically see is every 18 months or so, the market will typically correct by about 10%, even during the bull market, and then eventually head higher. So based on those percentage terms, this is normal enough. I wouldn't say healthy, but I think it's the velocity of the fall which has me concerned, because the volatility, how much the prices typically move was so low going into it. I think we're now into a period of higher volatility. And even if this bull market does resume, we've got to expect bigger swings in the prices going forward, and that in itself can unnerve investors.
Donald Trump often talks about how the stock market is a sign of a healthy economy. Is he right in that? Should we really be focusing on the stock market as being the underlying concern for the economy?
Well, I think Donald Trump probably made a big mistake, and maybe he's starting to realize it now, is that it's all well and good claiming responsibility for a healthy economy and healthy stock market while the stock market's going up, but obviously it does go down sometimes as well, and so you have to take responsibility for that too. I actually believe that stock markets generally act as a sort of forward discounting mechanism for the economy. So typically you see moves in the stock market ahead of what's going on in the economy 12 to 18 months down the line. So actually the economy looks very healthy right now. The global economy, we're seeing synchronized growth for the first time really since the financial crisis. But the market is sort of saying here that even if this isn't quite a top, the jitters in the market are telling us that probably there is a little bit of trouble down the line, and maybe into 2019, 2020 is when we're going to expect a bit of a follow-through trouble in the economy too.
People looking at their pension funds might be wondering whether or not the stock market really is a good investment for them. Do you think there's still more value out there to be had?
It depends on individual circumstance when it comes to pensions. If you've had a pension for a number of years, it's very difficult to time the market. So to pull your money out of the pension at the top of the market and then chuck your money back into the pension again after a market correction or a bear market, it's proven to be very difficult, because typically some of the best days in the market that make up a lot of your long-term gains, they actually follow after some of the worst days in the market. So and those are days that the average pension investor are not going to be feeling too confident about putting their money into the market. So timing-wise, as a long-term pension investor, it is better really. History has typically shown that it's better just to hold in there and wait it out. If you're starting a pension now, that's probably a different scenario. Maybe you actually, for the millennials out there thinking about their pensions, probably for them a big market drop would actually be useful to find them better prices to start their long-term investment.
We've heard a lot of talk about the effect that computer-driven trading, algorithmic trading, has had on these market moves. Is that a big factor for you in the size and scope of the movements we're seeing on the market?
Well, I think you've hit the nail on the head there, Stephen. It's not the underlying cause of the movements, but it can tend to exacerbate them. There are some sort of systemic questions that remain a bit unanswered here, and you do have these occasional flash crashes, which we didn't really see the other day, but they definitely, these fast market moves do tend to happen a bit more frequently when you have these very digitally based markets without the sort of traditional market maker. People who are standing there signaling to each other and are willing to make that market. When the market's falling, there's actually someone there buying in and offering a price for other people to sell to. When the computer algorithms are involved, a lot of them just have kill switch. If the market gets too volatile, these algorithms exit the market, and suddenly you've got a complete absence of buyers and sellers, and you see these big price moves.
OK, Jasper Lawler from London Capital Group, thank you very much for speaking to us. Lots of busy times ahead for you.
My pleasure, thank you.
Now, next to China, where authorities have been forcing businesses and consumers in Beijing to change their habits to reduce pollution. As a result, there's been a sharp fall in the number of severe pollution days in the city, down almost 50% in the past 4 years. Cleaner air does come at a cost to the economy, but many consumers are happy to make the changes. Our correspondents in Beijing sent us this report.
It's been years since people in Beijing have seen such consistent blue skies. This winter, air quality has been remarkably high. The amount of toxic particulate matter has dropped by 4.5% compared to last year. Why? Firstly, the weather. More wind has blown the pollution away. Secondly, authorities have taken radical measures. During winter, construction sites must stop, and a huge campaign pushing for a shift from coal to gas energy was launched last year, just like at Miss Zhang's house. Along with 2.5 million families around Beijing, she now has a gas heating system.
After we changed to the gas heating system, it was more convenient and cleaner. Before, we used coal. It was troublesome. I had to add coal to the hearth several times a day.
As a result, the price of gas has increased by more than 60% since last September. Some families can't afford it. Miss Zhang is tightening her belt, but says she at least breathes better.
This is the hearth we used to burn coal in. I had to put coal in here and then dredge the lower part. There would be smoke. It was very dirty.
But it's factories and coal power plants that are mainly to blame for the pollution, not individuals. The Chinese government is battling to ensure these companies don't dirty China's sky with toxic particles.
Beijing took care of the small, heavily polluting factories. The government's environmental department also hired 5,600 people to inspect Beijing and its surroundings for a year. They've examined a lot of companies and asked them to cut back pollution.
Despite these efforts, Beijing's annual pollution level average remains 6 times higher than that recommended by the World Health Organization.
Well, that's it from us for now. If you've any thoughts on the stories that we've been covering, do get in touch on Facebook at France24 Business, or you can tweet me at NewStephen. Until next time, thanks for watching.